Let's talk about the next step in the accounting cycle, which is called the financial statements. Now, this is what we mean by financial reports that we make at the end of the accounting period. These are called financial statements because they help us understand the financial performance and the financial position of a business. Obviously, you can have this for companies, sole trader. You can also have this for partnership if you want. So those are called financial statements. So for example, to give you more overview of what these are. So let me just write some things down so we at least get started on a very good way. Okay, so financial statements, if I had to define these, I would say these are structured reports. Okay, so which financial statements are there? First, we have something called the income statement, which is also called statement of profit or loss in some countries. So, what does income statement tell us? So, income statement reports the profit of a business by showing the revenues and expenses. Because I hope you understand that profit is basically revenues minus expenses. So of course, if you show revenues and expenses and you subtract them, you get profit. So that's what income statement tells us. It tells us the profit of a business, which obviously refers to the financial performance. It doesn't tell you the financial position, means right now financially how are we doing with regards to what we have and everything. So we'll talk about that just now. Okay, so let's talk about that. So second financial statement is called the balance sheet. This is where we report assets, liabilities, and equity of a business. Now, this balance sheet actually tells us the financial position of a business because if you know what someone owns and what that person owes, you actually are understanding how they are doing financially at that point in time, right? So let's assume there's a person, right? If a person has assets, because it applies to everything, right? If it applies to company, it also applies to a person. Let's say a person has assets of 100, let's say $1,000, and they have liabilities of $20,000. Now, if I ask you, how well do you think this person is doing? You'll say, yeah, this person's pretty well off, right? Because they have how much more in assets and liabilities? 80,000, which means they are in a comfortable financial position. However, if we change the numbers a little bit, and rather than these numbers, I change the numbers to, for example, let's say assets are 100,000, liabilities are, let's say, 110,000. That means equity will be minus 10,000, which by the way is possible. If you haven't seen it, don't worry about it. I'm just trying to make a point here. So now this person, you'll say, is in a horrible position. Even if I give it some like better terms, let's say liabilities are only 80,000. I'm saying only, obviously this is quite a bit, and equity will be 20,000. Will you say this person has a great financial situation or position? Of course not, right? Because this person is only worth $20,000. But it's also not like really bad. It's all right. Like it's all right position to have like $20,000 more in assets than liabilities. So I hope you get the point. When you're a business, you want to see your position, and to see your position, you'll have to look at these three things, not profit. Profit just tells you this year's or this accounting period's performance. I hope that is clear, because now I have to start talking about the third financial statement, something called the cash flow statement. Now, what does cash flow statement tell us? If I already know the profit and asset, liability, equity, what's left? So it reports the cash inflows and cash outflows of a business. Means where the business is getting their money from and where the business is spending their money to. So it is a very helpful thing to see, okay, how much the business is getting from the customers, how much the business is receiving from this area and this area and that area, and where are they spending their money, right? How much are they spending in repaying the loans, how much they are spending in paying the supplier. So it gives you another piece of, let's say, another angle of a company's current goings, right? Like how they are using their money. Are they using their money in a healthy manner or not? So obviously, in the cash flow statement, you learn all of these things. So for now, let's go to the fourth financial statement, which is called statement of retained earnings or statement of changes in equity. Let me use that one to be more thorough. Statement of changes in equity. So this one basically reports the changes in equity from start of the accounting period to the end of the accounting period, or rather I should say until the end of the accounting period. Because I hope you understand that equity is a very important number. Again, you can think of it as net worth, but it's not very accurate. But okay, for now let's assume it's net worth, right? Because it's very close to that. So I would want to know like what caused my net worth to go up or down during this accounting period, which is what I will use the statement of changes in equity for, because it will show me start of the year, this thing happened, and that's the final number because of those things. So very helpful thing to have for your business. So yeah, these are the 4 financial statements that you will need to learn, and yeah, I hope everything was clear. Obviously, I'll see you in the next video.